Okay, all right. Next, we'll explain the second rule of capital risk, one of our business rules. In every trade, we seek the best profit if we get it right. We'll get better or worse results depending on the type of business and investment. So, with this rule, we're going to explain that when we're going to make a trade within our stock, it's going to be always looking for the highest profit. So, we're going to do this example with this little representation of a very simple shooting gallery. Here it is, a little bit nicely explained. If we are going to look for, let's say, shooting at the target to obtain a prize, which would be a teddy bear, we are going to look, in this case, for the shot that gives us the most profit. In this example, it says that the brown bear on the left would give us a profit of $10 if we hit it, which is in this case the smaller profit. Now, if we shoot the blue bear to the right, we will get a prize of 20. And if we aim for the prize to the right of that one, which is the red one, we would receive a 30 profit. This means that with the same level of risk, doing the same thing, we would attempt to shoot it. Which one would we choose? I pause briefly for you to think about it. Who would you shoot if it costs you the same each shot? Each shot costs us $10, but each time, depending on which one we shoot, it will give us a greater benefit. Obviously, the decision would be to shoot the eye, the red one, the one on the right, the red bear, because it will give us 30 profit if we hit it. This means that a shot that costs us 10, the bear in this case would be worth it because it would give us 30. And obviously, we would not lose the shot because we have hit it in this case. It's a relationship with this idea. I'll explain it later. But understand this, that if you manage to hit the bear, it doesn't even cost you the shot. So basically, we win 30 and we don't spend anything. If we lose 10. In the case of the blue bear, I repeat, we would only win 20 if we win. It doesn't cost me anything for the shot. But in all cases, if I lose the shot, I lose 10. Let's see it below. Here, I explain it better in this table. Notice, if we shoot 10 times, here is the intention of this, to explain what would be the benefit of always aiming at the biggest bear. If we always aim at the red bear, in this case, and hit it, we will obtain a benefit, but we will always have a higher benefit. In other words, if we shoot at the red bear and hit it 10 times, we will get $300, because 10 times 30 is obviously 300. Without any cost, the profit would be the best. Let's take a look at this table. If I shoot the same bear, I always get better profit if I win all 10 times. However, if I hit only 5 times, which is half of the attempts, we would only break even in the case of the first prize, 0. In other words, we have spent 10 and lost 10, leaving us with 0. But in the case of the red bear, since each successful hit yields a greater benefit, even by guessing correctly half of the time, we would still break even. In other words, if we do not have a high-quality shot, but every time we shoot, we get a lot of profit, no matter how many times we miss within the statistic, every time we win, we will recover what we have lost several times. That's the intention of this we're going to see later on. We call this the risk-benefit ratio. In other words, we do not make negotiations where we do not have an intention or we do not have a clear possibility of winning, but several times, not only once, but several times. To 1. That's what we're going to know. Try risk-benefit 1 to 1, or 2 to 1, or 3 to 1, or 4 to 1. So, it is in itself, together with the previous rule that I explained in the last video, where you only invest a small portion of your capital, associating the rest to this strategy, where you are only going to shoot at the bear that's going to give you the most prizes. It is going to allow that in this statistic, which would be buying, which would be winning and losing, which is natural, in a balanced way. Every time you get it right, you get more profit. And that's what will gradually add up to you, if anything, money at the end of our period. Let's go ahead. So the second rule of capital risk would be to understand what I just explained. Obviously, if we're not very good, we're going to be kind of in a balance up there and down there. But as we get better and better, imagine if we practice as it says here, well, our aim, how many times you think your win ratio will be loss. In other words, the better you aim, and every time you hit the biggest bear, the red bear, we will always obtain a multiplier of our investment. In other words, Every time we aim, we are going to hit it. And in addition to hitting it, we are going to get a good profit. So we risk little capital and take a good profit. That is the rule explained in a basic way. If you didn't understand it, don't worry, you will understand it later. But that's what we want to achieve in this concept, that we become snipers. Every time we shoot, we get the jackpot. Well, in this slide, I'm going to explain, to give you a brief introductory. We're going to continue in a video below. How much can a trader earn? Because I just explained to you that if you earn every time you hit a good prize, and you're increasing little by little, obviously all of that is related to the size of the capital of our business. Remember when I explained to you that the size of the business had to do with the size of our capital had to do with our business. If we had a lot of capital, we used a small portion and we made a profit that was not very big, but based on the capital, it was always bigger. If the capital was bigger, we got a little bit more from that small percentage. Obviously, when I am talking to you, besides the fact that you can have a funded account, maybe not. If you have not understood well what a funded account is, it is working with the money of an outsider, that is, of a company that is going to hire us virtually as if we were operators of their capital, and they are going to give us an account depending on the size of the one we request, and we can, let's say, we can create that challenge for ourselves. So those accounts have obviously minimal costs with respect to what they give you. In this case, I'm showing you a slide of what I pulled from one of the pages of one of those equity funders called FTMO on my YouTube channel. If you want to see information regarding this, you can find it. It's called With Free Money. You can find it on YouTube. There you will see a lot of information that is not from the course, but it is related to all this about the funders of capital. And in this case, FTMO, which is one of the most common founders at the moment, one of the most solid, there are several and more. Practically, this FTMO gives you the possibility to test to certify an account. I will explain later what it is about, but what I want you to understand is that if you have a 10,000 account, which you apply for, which you approve because there is a trial period, at that moment, it becomes money. You really start to operate in the market. Ordinary way with that account that belongs to you, as long as you don't burn it. Burning means losing a minimum percentage that they will not allow you. It is as if they give you to drive a cab that is not yours. Let's put it in this case, and the cab you are going to drive it, you are going to use it, and every time you do a service, it is going to produce a profit. But if you scratch the doors, you pay many fines, the vehicle deteriorates, then in a moment the company takes it away from you. This is exactly the same. In other words, you have to take care of that capital, that balance, with much zeal. So these people that are here, taken from one of the months before I recorded this course, are exposed here as, let's say, the averages of that last month and how much profit they obtained. In this case, we will see that the first place, for example, obtained with an account of 10,000, 131%. This is a quite exceptional case. That is, this person had an account of 23,106. What does that mean? The difference between 10,000 and 23,106 is the profit that he made with that account. And from that profit, he is going to obtain in this business 90% of that capital. That is to say that from 13,106 approximately, well, exactly 90% was 11,795 of profit for this person that he received. He has it in his account. Once he decides to withdraw the money, FTMO transfers it to your account, and that is practically your profit. Imagine then, with a small 10,000 account, to have made 13,106 profit. The previous case, this gentleman, Ali M., I only give the name they give there, only made 23%, the previous 22%, and so on, or decreasingly. Let's see how in this list, the first 9 places stay within the 10, 14, 15, 16%. That's very good. I'm going to explain to close this video, that this profit practically is the standard, the average, that you can earn an account. And just I am talking about a 10,000 account, if that account is much bigger. Imagine how much it can be.